And it gives me great pleasure to bring on board Prashant Jain, who's not only a very dear friend, he's also a he's a well-wisher of the channel, never says no to us, and he's always been guiding and hand-holding our viewers at turning points, whether it's been a boom or a bust, whether it's been this decision between value or growth. Prashant's always been kind enough with his time and with his thoughts. Prashant, fantastic to have you back on ET Now. Thank you for joining us. We complete 12 years today. 12 years is 1 year. They say 12 also marks a new beginning. But before we talk about the new beginning, let's talk about the last 12 years. What's been your favorite moment of ET Now? And the minute I say ET Now, what comes to your mind?
I think, Nikhil, hearty congratulations to you on this achieving this milestone. And I enjoy being on your channel, and our conversations have always been very long-term oriented and very thought-provoking. And that is what I like about you and your colleagues and the channel.
Thank you very much. So let's stick to the tradition. Let's start with the long-term trends. Looking at the way how markets and the economy is currently shaping up, one side is inflation, which is not threatening to come back, but it is back. And on the other side, there is a visible recovery in growth and demand. If you have to balance the beam balance, growth versus inflation, valuation versus opportunity, how would you map things?
I think if you look at the last 10 years, it has been marked by underinvestment in the core industries in India and in globally. And what we have seen is that when you don't invest in a particular sector and demand keeps on growing, time comes when there is a mismatch between demand and supply. I think we are probably, looks like would be at that stage. And therefore, I think inflation, at least, it may not grow year on year, hard to say, because the base effect is always tends to reduce inflation the next year. But I think the sharp underperformance that we saw in capital spending, in commodities, I think probably is behind us. And I think what ESG concerns have done, they have impacted the supply side more than the demand side. And that is not a very good thing to have happened, because you can see now large corporations in the world are shying away from opening up new, supply sources. There could be a period of demand supply mismatch. This I could believe could lead to some inflation and also a change in direction of the stock market.
When we started the year, the view was that we have recovered smartly from the first wave, while globally, world was still struggling on the medical front. But post-April, the view has changed. On the medical front, world is doing better, and we've had our own struggle and challenge because of the second wave. Does that change anything?
I think, clearly, I think the crisis seems to have abated. And this is how, the world, the societies, the governments are extremely resourceful. And whenever there is a crisis, you bring a lot of focus, energy, effort on dealing with the crisis. And seldom we have seen this crisis last very long. So I think it is safe to assume, though no one can guarantee, that I think we seem to be winning this second wave. And interestingly, world over, if you see, the markets did not fall during the second wave. So that again shows the optimism going ahead.
We've been talking about value, and a value investor like you always focuses on assets which are available below the intrinsic value. You've been patient, but looks like that call is now working. SBI is outperforming HDFC Bank, Tata Steel is an outperformer, the value in PSU oil companies is getting recognized. Do you think value investing is back, and now the markets have decisively turned in terms of a cycle change?
I want to clarify one or two things. I think there are some misconceptions about value investing, at least the way I look at it. Value investing is not about buying, companies around book value or below book value, buying only old businesses or buying businesses that don't grow. I don't think that is value investing. I mean, and to my mind, value investing simply uh, suggests that I will price growth, whatever is my assessment of the growth going forward. And I don't want to pay a very aggressive price than what is justified by the current and future prospects. And because a great business, even if it is growing well, if it is overvalued, may not turn out to be a good investment. I think that is how I look at value investing. And we have invested in growth businesses also at different points of time. I think somewhere over the last few years, the even some sectors became extremely expensive and they were not even growing that fast in India. And while others continue to underperform, I think certainly it appears that that cycle is changing. It took a while too long this time around. Even earlier, we have seen similar periods, but I think this time it just got a bit extended. But I've also seen that the longer the period of underperformance, the more sustained and the sharper should be the outperformance. So I think value is, I mean, the way most people look at it, I guess, is coming back. And what is supporting that is uh, one, in India, the corporate NPA cycle is clearly behind us. I think everyone agrees on that now. And also the bank's balance sheets or the asset side, asset mix has converged between various leading banks in terms of retail and corporate loan books. So I guess the going forward, the big divide in valuations that we saw over the last couple of years may not sustain. And I think as we move ahead, what has also happened, because as a reaction to the lockdown and economic conditions last year, interest rates have hit the bottom, and governments across the world are focusing on infra. And as I said earlier, last 10 years, the world has invested very little in capital intensive or core businesses. I think we are looking at a situation where demand could possibly exceed, or supply may not be able to keep pace with demand. And that's why you are seeing a sharp increase in commodities across the board. I think interest rates have also are bottoming out, and I believe rise in interest rates will be more negative for the very expensive sectors, because the more expensive a sector is, the more longer term, the more higher growth, the more into the future are the cash flows. The impact of any rise in discount rates impacts those businesses far more. I do feel, and I also hope, that what changes we have seen in the last few quarters, I think this should sustain. In the end, I have seen that the most important thing to keep in mind in investing, apart from, of course, the quality of the business, the sustainability of the business, I think price has a very important bearing on the future returns, at least over the medium to long term. Short term, of course, is extremely hard to.
Okay. How would you then assess the future of PSU stocks? A year ago, 6 months ago, PSU stocks were underowned. They were bombed out. They were called the ugly ducklings in the world. Now they are the new rage. Do you think PSU stocks, since you have ownership in a lot of PSU stocks, they are fairly priced, or they are still at the beginning of a growth cycle and new capital allocation policies there have started?
I think PSUs I think as a group of companies have been misunderstood by across the board. That's what I feel. And see, one, PSUs have not been perpetual underperformers in the stock market, and the underperformance was very stark in the last couple of years. And that is not backed by financial performance of these companies. If you look at last 5 years, the profit growth of PSUs was actually more than the broader markets. I believe this underperformance was possibly a result of the ETFs, which the government has hinted that they are unlikely to adopt ETFs as a divestment tool. The focus is now shifting to the strategic sales. So I think the real value of these companies will uh, come out, and that overhang of ETFs is no more there. To that extent, I think from a stock market perspective, the environment has turned positive. I think the second and more important thing is that what is happening in the broader economies and what is happening across sectors. The PSUs, if you look in the Indian context, most of there are no PSUs in IT, pharma, FMCG, retailing, chemicals, etc. PSUs are concentrated in banks, in oil and gas, energy, coal, mining, and in the power sector. I mean, bulk of the PSUs are, and these sectors were also underperforming. But since almost all PSUs were on in these sectors, you thought that uh, everything is bad. I think both these factors did not work to their favor. And but now I think even the sectoral outlook has changed. If you look at what is happening in the energy sector, if you look at the way oil prices are behaving, if you look at the way coal prices are behaving, and so I think the coming back to profitability of the core sectors of the economy, the changing outlook towards these sectors, the end of the corporate NPA cycle, the sharp improvement in the profitability, banks that were carrying the burden of corporate NPAs. I think the business performance, the profit performance is also supportive of these businesses going forward. And finally, I mean, the underperformance was so stark, so acute, and the almost everyone was extremely negative on this sector. Such situations lead to deep undervaluations. I think that is what uh, it has been partly corrected, I believe, but I still think there is significant room in many of these sectors because even the current valuations are significantly below long-term averages. And we still have cases where even the dividend yields in quite a few of these companies meaningfully exceeds the borrowing cost of these companies. These are growing, successful companies. I think there is room to be optimistic on this.
Okay, so let me now phrase my next question rather carefully. For next couple of years, which part of the market do you think we are in for a growth surprise? Where do you think we are in for a growth disappointment, where markets are today pricing in too much, but you think markets will be disappointed? And where do you think growth will be there, but prices may not go higher? When I say stock prices will not go higher because markets are factoring in that growth.
Nikunj, I think if you look at the current valuations versus the last, let's say, 10-year averages, I think the current valuation relative to last 10-year averages is the highest in the consumer space. And this is a very good space. This represents extremely high quality companies. There is no denying that. But I believe this is not a high growth sector. And if you look at the top line growth, the sales growth of most of these companies over extended periods, it has been in high single digits or barely in very low double digits. The profit growth has been somewhat better, supported by significant expansion in margins, supported by indirect and direct tax cuts. I think going forward from the current high base of margins, it appears the significant margin improvement should be less likely. And in any case, you are seeing broad-based inflation. And tax cuts again, I don't think from where we are is looks like a possibility. I think the profit growth in this sector, while it should be there, I don't think it justifies the multiples this sector is trading at. The I think the more important point, or equally important point to be kept in mind, is that what was happening in other sectors. Most other sectors were struggling for a variety of reasons. CapEx was weak, commodity prices were low, corporate profitability in core areas were weak, NPAs were high. So, and pharma again had a challenge of a very high base margins about 6, 7 years back. So that was also mean reverting in a way. So various sectors like pharmaceuticals, commodities, uh, capital goods companies, banks were struggling. And these are large pockets, large segments of the market. And therefore, in an environment like this, even the somewhat, I would say, medium growth or low growth of consumer companies was richly valued because there were nowhere else to hide. I think going forward, one thing which has decisively changed is the revival in profitability across the board. And it is more surprising in a way, it is ironical also that last year saw the highest ever, growth in Nifty EPS. And it is fairly broad based. So metals, capital spending, banks, chemicals, textiles, paper, the core sectors of the economy have are doing very well. Corporate profitability has revived very strongly. And this, I think, makes a fit case for a significant revival in private capex. And we have been hoping for last several years that private capex will revive. But I think now the environment is more conducive and one feels far more confident about it happening in the foreseeable future because simply because the corporate balance sheets in the core sectors of the economy are extremely healthy. The cash flows are good, profitability is good. And when we look at companies that we cover, and when we look at the announced capital expenditure plans over next few years versus what these companies have done over the last few years, there is definitely a significant increase in the planned capex. I think that is one sector where we could expect meaningful acceleration in.
But there are a lot of disruptive changes which are happening, which is the way fuel is moving from thermal to solar. The combustion engine is moving towards EV. These disruptive changes surely will have an impact on the way how normal commodities were consumed, how companies which are in the construction and EPC business, they were getting their revenue. Are these disruptive changes which one needs to be mindful of by judging some of these companies?
You are right, and the energy is a field which is undergoing a lot of change, and there is no doubt in anyone's mind, and I don't think anyone will argue that there is both a need to resort to more cleaner forms of energy, and also that over time the share of clean energy should and will go up. I think what is at issue here is that this view or is a very simplistic view to take that conventional energy has no future. And I mean, even many companies have taken that view and they have stopped investing because of either this view or because of concerns around ESG. Now, the only point I want to make here is that demand will take its own time to come down. And no one is sharply incentivizing you to, the economy simply or anyone simply wants to buy energy at the cheapest price. That's what consumers do. Till the time, I think in economic terms, there is parity. And till the time the green energy is available round the clock, and which will happen when storage becomes economically viable. Till that time, I think conventional energy will continue to play an extremely important role. Look at what is happening in China. Look at the growth in coal demand. Look at the growth in thermal power. And please bear in mind, last 10 years, I mean, even in a country like India, how many thermal plants have we set up? I mean, I can't think of any new thermal plants that have been planned. But demand continues to grow at 6-8% a year. How are we going to meet that demand? I think whether we like it or not, the at least in the Indian context, uh, it may happen even outside. But I will not say that because I don't know for sure. But I think strongly in the Indian context, we will need more conventional energy. And but what has happened is supply has dropped faster across the world. I mean, you look at what BP, Shell, Exxon have been saying. There is hesitation in investing in new oil fields, but demand continues to hold up well. I think it will be very interesting to see how the energy prices are impacted into the over the next few years. I mean, you can't take this view for 10 years, but I think for quite some time, uh, we may have to contend with higher energy prices.
Works with the assumption that a KPIX cycle is started, corporate balance sheets are better, corporates are looking at investing. It reminds us of 2003 and 2008. That's the time when commodity prices, KPIX cycle, power sector, power capacities, thermal coal capacities were getting created. But Prashant, that time a lot of mid-cap companies also flourished in the EPC space, in the construction space, in the power space. That is the missing link. So even though the patterns of CapEx cycle are bigger and higher because of the base of the economy, the number of players are less. What does that mean?
No, Nikunj, I think there are, I mean, as they say, history rhymes, but is need not repeat. So I think this is a apt phrase to describe these 2 points of time. So there are similarities between 2001, 2, 3, and now. And that time, growth was very expensive, but it was tech. Today, again, I think growth is very expensive, but to my mind, in my limited understanding, it is represented by the consumer sector. Uh, that time, the commodity prices were extremely low at the beginning of the cycle. Today, we are not in that phase. Today, if you look at many commodities, they are significantly above the cost curves. You could say we were somewhat closer to there some time back, but if you look at the steel prices today, yeah, I mean, any part of the world, it is simply hard to believe the steel prices, the spreads, what we are seeing. Then, if you recall, it took almost 6-7 years from 2001 till 2007 for commodity prices to keep on rising. So, but I think the capex part of it, I think we were at the bottom of the capex cycle in India way back then, both infra and industrial private capex. Today, I think we can't say that for the infra capex because we have a fair bit of focus on that in last few years. But I think indeed private capex we are at probably the bottom, and to that extent, I feel next few years we should see a significant revival in industrial capex. And last point, last but not the least, I think the starting multiples way back in 2001, I do recall markets had fallen to almost 9 times, 9p, and that was also a year when retail interest in equities was probably the lowest ever. I am saying this from memory. I think that year saw a net inflow in mutual funds of just 142 crores. It was the lowest ever in a long, long time. So I remember having done road shows, and people used to tell me, look, you are selling equities just because you work in a fund, but for 10 years, markets have not given any returns. I think equities were deeply out of favor. And today, I think neither the multiples are that low. And certainly, you can see the retail interest in equities is completely different. So I would argue that while there are similarities between then and now, there are quite a few things which are quite different as well.
Let's wrap our today's discussion with a very straightforward question. We are at a record high, and pockets of deep, there are a lot of pockets where prices are higher than the projected earning growth and where things may be looking slightly frothy. So if you have to, let's say, share a view based on your experience in terms of the starting point, for next couple of years, which is 3 to 5 years, are equity investors in for double-digit returns, or that will be a tall order?
I think, Nikunj, we are at a situation where markets in aggregate terms are fairly valued. If you look at India's market cap to GDP, and I focus on fiscal 23 and not on fiscal 21 last year, because last year GDP contracted. It's a wrong base to look at the market cap to GDP ratio. I think, and in 3 months' time, we are in June, in 3 months' time, everyone will shift to March 22-23 year, fiscal 22-23. Based on that, as per my memory, markets are at around 90% market cap to GDP, which I think is neither expensive or nor cheap. It is just about right. But the moment you bring in the current low cost of capital, I think this appears quite reasonable. Please remember that today you are buying government bonds, 10-year bonds at 17p. 6% translates to us 17p. To that extent, I think in these days of low cost of capital, one can work with slightly higher multiples. Of course, the risk is to what extent and how fast the cost of capital can or will increase. While I am observant of that, I am not too unduly worried, because let us remember that it is the US interest rates which have collapsed. Interest rates in India are not the lowest ever. In 2005, the Indian 10-year yield was 5%, and US 10-year yield was roughly about there as well. So you can see the sharp fall is in US. So, but if those yields go up, it could lead to some corrections in the markets. But I think in a fast-growing country like India, some increase in cost of capital markets can take in their stride, because you are a fast-growing, reasonably fast-growing economy, and the outlook for profit growth, importantly, is quite positive, and it is fairly broad-based this time around. I think next few years, returns will also be a function of the inflation. Because if your market cap to GDP is fair, then what becomes the key is what is the nominal GDP growth going ahead. I think maybe real GDP growth of 6 to 8% and 4 to 6% inflation, that brings you to 10 to 14%. I think one can make a case that over the next few years or medium term, return should be in line with those numbers. But I think the returns across sectors could vary significantly. And portfolio returns will also be a function of how you are positioned. But there clearly, stock markets represent a duality of opinion. As we know, every trade represents, for the same company, same time, same price, same everything, two opposing opinions. So while I have my opinions, but I am sure there are others who think completely different.
Prashant, your opinion really matters, and thank you for sharing your thoughts and your opinion, not only today but in the last 12 years at important turning points. Today indeed is a special day, and we are speaking at a time when everybody is trying to get trying to find the answer to one question: are we in a bubble, or this bull market still has some more legs? Appreciate your time and stay safe.
Thank you, Nikunj. Thank you.